Welcome to Retirement Risks. In our prior video, we went over the introduction to retirement risks. We shared with you a little bit about the objective, the mountain chart of how people look to retirement and how they focus in on the pre-retirement. And what we wanted to do is share with you some of the challenges that people have during the distribution phase, the retirement risk section, where we go over market volatility, interest rate risk, longevity risk, and long-term care. So let's get right to it. The first risk that we face is market volatility. We have a case study we want to share with you. That case study shows an individual with $2 million in his portfolio in a pre-tax IRA. The objective of this particular client was that he wanted to take out $150,000 a year every year out of this portfolio so that he could net out after tax $100,000, assuming a 33% marginal income tax bracket. Now, we're going to assume that the IRA will have the same annual returns as the S&P did from 1973 to 1987. Now, during that period of time, there were some negative returns that were early, and the portfolio averaged during that 15 years 11.28%. There was, however, 4 negative years in the early part of the 15 years that we're modeling here. The index declined in value over the first 2 years by 36%. Let's consider the retirement account under 2 different scenarios. Scenario 1, the individual Robert takes out a taxable distribution of $150,000 each and every year for the 15 years. And in the second scenario, Robert will avoid taking a distribution in the year following a negative year. And let's look at how these 2 different scenarios worked out. In the first scenario, as you'll see, we start out with $2 million. We had a negative 14.8%, and we pulled out $150,000, so we were down to $1.5 million. The following year, we took out that same $150,000. The market went down by 26%. We're already down by almost half. We're down to $1 million. And at that point in time, it's going to be very difficult to pull out $150,000 on a portfolio of about $1 million. Distribution rates are recommended to be around 3 or 4%, but this client needed to take out 7.5% of $2 million. The result over the 15 years was this account went down to $900,000, certainly not helping him arrive to base camp successfully. So what we want to do is compare and contrast this modeling with a different kind of modeling where you're taking out that same amount of money but not withdrawing from the portfolio in the year following the market going down. And let's see what happens. Here in the second year, the year after the negative 14, we don't withdraw the $150,000. And again, after the 26% in the second year, the negative 26 in the second year, we don't withdraw. In the fourth year or the fifth year, at age 70, we don't withdraw after the negative 7. And the only time we withdraw in this modeling after a negative year is to take a required minimum distribution because the client would be over age 70 and a half. In this scenario, we took out $500,000 less, but we ended up with $2.4 million more. $900,000 versus $3.3 million. Pretty compelling difference. So let's summarize. Scenario 1, $2 million. We took out $150,000 for 15 years, or $2.25 million. At age 79, client ended up with $900,000. Scenario 2, we took out $1.749 million, about $500,000 less, but we ended up with $2.4 million more, or 272% more money, because we did not withdraw in the years following the market going down. Let's turn to now interest rate risks. We are at a point in time where interest rates are very, very low. Even 2% might seem high for some people today. But if we were going to be very conservative and we had $2 million in our portfolio and we needed to take out for our lifestyle $150,000, we would run out of money in this scenario by year 17. We would be at a negative balance. If interest rates went to 4%, we would still run out of money in 19 years. If interest rates went to 6%, we would run out of money in 25 years. And if interest rates went to 6%, there would probably be a market correction to the value of your bond or fixed income portfolio. So you might not have that $2 million. At $1.5 million at 6%, we would run out of money in about 15 years. So the interest rate risk is another major challenge for people trying to set themselves up properly for retirement planning. The next risk we want to talk to you about today is longevity risk. Medical technology, medications, nursing homes. We are getting better at keeping people alive longer. People are living longer and longer. Here we have is a mortality chart showing the life expectancies of two 60-year-old people. The first line, the blue line, shows the life expectancy of a healthy, and I stress a healthy, 60-year-old male is 87.6 years is his life expectancy. The green line is the life expectancy of a female age 60. A healthy female age 60, life expectancy is just short of 91 years. And the red line is what we call the joint life expectancy, the probability that one of these two people will be alive. So that goes out to age 94. And understand what life expectancy charts are. Basically, they're saying that half the people will be alive and half will be dead. So there's a high probability that if you're 60 years old and planning for retirement, that one of two of the spouses will be alive at age 94, requiring people to be thinking about a longer period of time for their retirement. So longevity certainly plays a large part in the planning that people need to be thinking about when they start approaching retirement, that their income needs to last not for 10 or 20 years, but 30 and even 40 years. Long-term care. Let's talk a little bit about long-term care because that's another potential risk for your retirement portfolio. And without an adequate solution for long-term care, people are facing some really big challenges with being able to take care of themselves and generate the income they need. What's the cost of care in our community? We're in New York, so we're going to use the New York numbers. The average cost for a home health aide in New York is $35 an hour. For a homemaker, $33 an hour. Tremendously expensive for home care. For a semi-private room in a nursing home in the metropolitan area, $500 a day for a nursing home. These costs can be devastating. $15,000 a month, $180,000 a year can absolutely impact the portfolio for your retirement. But where is the pricing going? Healthcare is one area that continues to become more and more expensive for people. So if the average cost nationwide of a nursing home in 2012 is $90,000, and the consumer price index for nursing home and adult daycare is growing at 3 or 4%, 20 years from now or 23 years from now, it's going to go from $90,000 to $270,000 a year. Certainly a tremendous part of retirement planning needs to be dedicated to a solution for long-term care. So, what I want to do now is share with you some of the solutions, or the solution that we're going to recommend for your retirement risks.